Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, Mr. Jeremy Timkulu. In this video, I would like to take you through vertical groups. Okay, this is part of the requirement or the study area in professional examinations like the ACCA, SBR paper, the Strategic Business Reporting paper, as well as other various professional accounting qualifications the world over. This video is going to assist you in actually understanding what would be going on with vertical groups, where one company purchases another, and that company which has been purchased also purchased another company. So that's a vertical group relationship. It is actually part of business combinations in terms of Ifrs 3. Okay, so in this video, we're going to take you through the process of doing the consolidation with regards to vertical groups. Now, for you to easily identify that this relationship is a vertical group, it is actually depicted as follows. There is a parent company, let's say P, which has acquired shares in a subsidiary S, and then this subsidiary acquires another company's shares, and let us refer to that as T. Okay, so which means these three companies are in a group relationship, but doesn't mean that always P has to first acquire shares in S and then S acquires T. It might be the case that S first acquired the shares in T before S was acquired by P. So you just have to watch out, and those are actually issues or examination pools, exam question pools in many examinations worldwide. Okay, so how do you identify the acquisition date or the date when the effective control was achieved? The rules for vertical groups are as follows. All right, the acquisition date for a subsidiary in a vertical group depends on whether the holding company H acquired its shares in subsidiary S before S acquired its shares in the sub-subsidiary T, or the holding company H acquired its shares in subsidiary S after S acquired its shares in the sub-subsidiary T. So the rules which apply in both of those situations are as follows. If the holding company H acquired its shares in sub-subsidiary S before S acquired its shares in the if the holding company H acquired its shares in subsidiary S before S acquired its shares in sub-subsidiary T, then the date that T becomes a member of the H group is the date that S acquired the shares in T. Why? Because already S was part of the group, all right? Then at the date when S acquired shares in the sub-subsidiary T, then automatically that date when S acquired shares in the sub-subsidiary T becomes the date when T becomes part of the group. Then in another situation, if the holding company H acquired its shares in subsidiary S after S acquired its shares in the sub-subsidiary T, the date that T becomes the member of the H group is the date that the holding company acquired the shares in S. That's very simple. Pre-acquisition reserves and post-acquisition reserves are calculated for each subsidiary and sub-subsidiary from its date of acquisition. So, ladies and gentlemen, let us get to grips with this with these rules with an example. Okay. Now we've got example Bensot. Bensot, a public limited company, purchased 6 million shares in Redo, a public limited company, on 1 January 2017 for 10 million. Redo had purchased 4 million shares in Petrol, a public limited company, for $9 million on 31 December 2014. So which means what happens was that Bensot, which happens to be the parent company or holding company, purchased shares in Redo, but Redo had already purchased the shares in Petrol some time ago in 2014. All right, when its retained earnings stood at 5 million. So you can see that this this rule is the one that is applying in this case. Okay, the balances on retained earnings of the acquired companies were $8 million and $6.5 million respectively at 1 January 2017. These dates are being put for you to understand which one was the date of effective control when the subsidiary became part of the group. Okay, we are told that we need to come up with the group structure so that we understand what is going on. So I usually encourage students to come up with a drawing, okay, because the drawing is usually effective. Of course, because of the CBE environment, drawing is no longer something that is easily done on the computer, okay, because the markers are not going to give a fuss on that. But for practice purposes, you need just to draw this graph, this drawing for the group structure. So you can say workings, the working number one, group structure. Okay, so sometimes you need not to finish reading everything because of the time constraints. Okay, somebody would be worried and say, why can't you just read everything? Okay, we are going to read everything just for the purpose of learning, but in the exam you just have to, the moment you start to read the first or two lines, you then have to have an idea and start to draw your thing. Okay, because the examiners are not going to allow you to dilly-dally with their time. Okay, so in this case, Bensot, a public limited company, purchased 6 million shares in Ridu, a public company, on 1 January 2017 for 10 million. So if they purchase the 6 million, what is the percentage shareholding did they acquire? All right, so we need to know the total number of shares for Ridu. So we go to the balance sheet and we consult the ordinary share portion. Okay, Ridu is said to be having ordinary shares worth 4 million, but this is equal to the 4 million, okay, divided by the par value, right? And this should become 8 million. Okay, that's 8 million. If you use your calculator, 4,000 divided by half, it means that's 8,000. But remember, these figures are in thousands already, so that's 8 million. Then, so this one was Ridu. What about the number of shares in S? In S, we are saying, we are told that in Petrol, we are told that the shares had a value of 2.5 million. So 2.5 divided by 0.5, this means there were 5 million shares in Petrol, not S, but Petrol. Okay, so in our group structure, we're going to say the holding company B purchased shares in ARA, Ridu. Okay, they purchased 6 million according to the question. That's 6,000 over 8 million, and this means they purchased 75%, and automatically the NCI is equal to 25%. Then ARA purchased shares in Petrol. We are told that Ridu had purchased 4 million shares in Petrol, a public limited company, for 9 million on, so there are 4 million in December 2014. So we are saying 4 million divided by 5 million, okay, this should actually be 80%. Okay, but does it mean that the NCI is 20%? Because we need to worry about the effective control, okay, in P, all right, the effective control in petrol, which we need to compute. So what is the effective control? We know already that, of course, 80% was acquired. All right, let us just write the dates. All right, the first one was acquired on 1 January 2017. Okay, so that's 1/1/17, and this one was acquired on 31st December 2014. Okay, so that's what was happening. All right, the dates are confusing other people. They are saying where you have put them, we are not used to that. Okay, let me just say 1 January 2017, and here acquisition was 31st December 2014. Okay, so effective control of Bensot in P, effective control or effective interest in petrol is obviously, we know that Bensot purchased 75% and Redo purchased 80%. So we need to multiply the two figures and get the effective control in P. So that's 75% multiplied by 80%. This should lead us to a percentage which is 60%. Okay, and obviously when we know that the effective control in P is 60%, then obviously the total percentage should actually be 100. Therefore, the NCI in P is 40%. Okay, because the control which has been achieved in a P is 60%. Obviously, the NCI should be 40%. So we are done in terms of the group structure that is involved. Then we have to move forward. The fair value of the identifiable net assets and liabilities of Redo and Petrol was equivalent to their book values at the acquisition date. The statements of financial position of the three companies as at 31st December 2021 are as follows. So that's the information from the three statements of financial position for these companies. Then you need to read the extra notes. Group policy is to value non-controlling interest at fair value at acquisition. The fair value of the non-controlling interest in Redo was calculated as 3.230 million on 1 January 2017. The fair value of the 40% non-controlling interest in Petrol on 1 January 2017 was 4.6 million, and I'm sure by now you now know how we obtained the 40%. In this case, the examiner would have been so generous to you. The impairment test in current and previous years did not review any impairment losses. Okay, so ladies and gentlemen, let us do the workings. So let us calculate goodwill, because it is from these workings that the majority of our marks are going to be obtained. So we call this working number 2, goodwill. All right. So we've got two companies. We've got Redo, we have got Petrol. All right, that's where we are going to obtain our goodwill, okay, on acquisition. So all the figures, remember, they are in thousands. Okay, we have got these figures in thousands. Okay, so we then have to consult the purchase considerations, or the considerations which were transferred in the acquisition of each of these subsidiaries. So the first one was 6 million, was 10 million, which was transferred. Okay, because from the sometimes the exam does not tell you that they transferred 10 million, but you need to pick it from the statement of financial position. So this is the consideration price which was transferred for the acquirement, for the acquisition of Redo, and then this one was transferred for the acquisition of Petrol. Okay, you can also read these parts. Okay, so we go to our working. You can see, ladies and gentlemen, that I have come up with 4 columns, which should actually be a logical presentation. All right, so consideration transferred. All right, we are told that in Redo, they transferred 10 million. And in Petrol, they transferred 9 million. If you visit your question here, they're saying they transferred 9 million for those 4 million shares. So you come here. All right. When you come here, ladies and gentlemen, remember, you have established that B is the parent, R is the subsidiary, but P is a subsidiary. Why? Because it is a subsidiary of a subsidiary, R. Okay, so P is a subsidiary. So the effective interest in P is actually only 70. In the views of B or the group, B did not actually purchase 80% in R. Okay. The consideration which R paid in the eyes of B was only 75%. Okay. When R purchased the shares in P, okay, which constitute 80%, in the eyes of B, the consideration which was transferred was not the 100%, or was not the full 9 million, but 75% of 9 million was actually used to acquire P. So that's how in the group it is viewed. Okay, so we say now the consideration which was transferred, okay, we say 9 million. Let me try to use another pen. This is where, ladies and gentlemen, the consolidation become interesting, okay, because if we do not get it right, we are going to be lost. All right, only 75% was paid in respect of those shares according to the group's view. All right, so this becomes 6750. That was the consideration which was paid. And then we move on now, because we are using the fair value method of valuing goodwill. Then we just have to add the non-controlling interest, as we know, the NCI at acquisition. Fair value. Okay. All right. So this one was given in the question. The fair value of non-controlling interest in Redo was this much, and the fair value of the 40% interest was this much. Okay, so we just have to use those values. So that's 3.230. All right. And here that it was 4.6. $4.6 million. Okay, we then have to deduct the fair value of net assets. So less fair value of net assets, less fair value of net assets at acquisition. Okay, our net assets at acquisition, we are told from the question, the balances on retained earnings of the acquired companies were 8 million, okay, and 6.5 million respectively at 1 January 2017. All right, but we were also told that Redup had purchased petrol in 2014 when the retained earnings stood at 5 million. So, ladies and gentlemen, which figures shall we use as part of the retained, the net assets at acquisition? Shall we use those retained earnings for 2014, or we are going to use the retained earnings as at 2017? This is why I said that this example actually relates to this second rule. If the holding company H acquired its shares in subsidiary S after S acquired its shares in the subsidiary T, the date that T becomes a member of the group is the date that H acquired its shares in S. All right, we know that subsidiary S had acquired the shares in Petro in 2014. However, S was acquired, that is Redu. Redu was acquired in 2017. So the 2017 retained earnings are the ones that are applicable for the purpose of our consolidation. Are we together, ladies and gentlemen? Okay. Your silence actually tells me that we are together. Okay, your silence actually tells me that we are together. So we are going to use these values, the 8 million and 6.5 million, because those are the retained earnings at which the group relationship was effective. Okay, the 2017 retained earnings. So we come straight to our workings and continue. All right, so remember, we start with the share capital. The share capital, usually this figure does not change. You just have to pick it as it is from the balance sheet. That's 4 million and 2.5 million. So you just have to slot in the figure as they are. All right, so that's 4 million for Redu and 2.5 million for Petro, and then the retained earnings. Retained earnings. These are called pre-acquisition retained earnings. Okay, pre-acquisition. Okay, so we discover that they are 8 million and 6.5 million. So that's 8 million, 6.5 million. You add them up, you get your 12 million. Remember, these are net assets which should be deducted from our considerations and NCI above. So here, if we deduct, we are left with 1,230,000, and there we are left with 2,350,000. Okay, We then have to add up these. You can just add them up to get the total goodwill of 3580. Then when we do this, we can congratulate ourselves as having passed the exam. Then another working that is of paramount importance is working number 3, retained earnings, which I have discovered that this one is a bit problematic. Okay, so we have got our Bensot, we've got our redo and petrol. Okay, and every figure, as you have already seen, is in thousands. All right, so we first have to pick the retained earnings as at balance sheet date. At the balance sheet date, okay, we know that the retained earnings for the parent is 25 million, that is for Bensot, and for Redo is actually 20.4 million, and this one, you just have to pick this one as per the question. So you can tell the examiner as per question. Okay, as per question, all right, we are seeing 25.5 million. All right, 5.5 million and 20.4 million and 16.3 million. 20.4 million and 16.3 million. Okay, once you do that, you then have to consider the retained earnings at acquisition, because these ones have to be deducted. Retained earnings at acquisition. Okay, and these ones are actually those which you had used in your computation for the goodwill. They're just the same figures. Okay, this one, this figure, and this figure. Okay, you are left with the retained earnings post acquisition. Okay, so 20, that is 12,400, and here you just have to have some 9.8 million. All right, you then have to add them up. You can just simply have to add these ones up. What do you get? Okay, let me just try to rub it off. I'm sorry, here you don't need to add anything there so far. All right, that's too early. All right, so you then have to consider the group's share of post-acquisition and retained earnings. So the group's share of post-acquisition retained earnings. Okay, and this one you would be splitting according to the share. All right, our interest, our controlling interest. For example, in redo we had we had 12.4 million as the 12.4 as the retained earnings, but we control only 75% of the company, so we are entitled to 9.3 million. And then in petrol, we only control, the effective control is 60% according to our computation in the group structure. Okay, the group structure computation, we saw that we control the effective interest in P was 60%. Okay, so we're going to say this 9.8 million multiplied by 60%. And for the group, we are going to get 5.880. Okay, so far these are the only information which we have for the retained earnings. So that's 25 plus 9.3 plus this one, we are going to get 40.680. That's the group RE, group retained earnings. Okay, we then have to proceed to the non-controlling interest. That is working number 4, non-controlling interest. This one now, we have to have our redo and our petrol here. Okay, everything is in thousands. Now, the NCI at acquisition, we were given in the question, okay, because you can also incorporate what you have obtained in your calculation for the goodwill. So you just have to pick this figure and that figure because they were given in the question. All right, the NCI there was 4.6 million. Is that a 4.6 million? Where is my 6? It has disappeared. All right, fine. That's good. So that's 3.23 million, 3.23 million and 4.6 million. Okay, because we are using the fair value method, so it is actually given in the exam. And then we have to worry about the NCI share of post-acquisition RE. Okay, retained earnings. So because we had already given the 75% to the group, therefore the 25% should come to the NCI of the retained earnings of Redo. So Redo had 12,400 in terms of retained earnings. So that's going to say 25% multiplied by 12,400, and we must get 3.1. Okay, and in petrol, the NCA was 40%. Okay, 40% multiplied by the RE, which was 9.8. Okay, and once we do that, we then have to get our 3.920. Then we have to deduct the NCI investment, in petrol. NCI investment in petrol. This is why I said in the group's view, we did not pay the whole 9 million for the shares in petrol, but only 75%. So we also have to deduct the NCI investment in petrol because this is not part of the group. So we are going to say we paid 9 million through the subsidiary Redo. So 9 million was paid, but the 25% was for the NCI. So this one has to be deducted not from petrol but from Redo itself. So Redo did not pay this 25%. It was paid by the NCI. Okay, so that's 2250. All right, once we do this, we then have to underline. Okay, and if we use our calculator, 3,230 plus 3,100 minus 2,250, we must get our 4,080. And here we then have to add up again, and we must get our 8520. Then we have to add all these ones and obtain our 12,600 as our ultimate NCI value. Okay, once we are done with the workings, we then have to come up with the statement of financial position as required by the question, the consolidated statement of financial position of Bensot as the 31st December 2021. So this is the Bensot group statement You can just say consolidated statement of financial position as at 31st December 2021. Okay, everything should be in thousands. So we start with the non-current assets. If you just label your work presentably, you are going to win some marks. All right, remember this is now a consolidation for the subsidiary and the parent company, so it's a line by line consolidation. So we say PPE, property, plant and equipment. We then have to take everything in the line coding. So we are going to say this one plus this one plus that one. All right, so that's 14.5, 14.5 plus 12,140 plus 17,500. Okay, going to have our 44,100. Okay, 44,140. Okay. All right, we go to the other assets which should be shown within our statement of financial position. You can see that these ones now, because we are in consolidating the group, obviously in the group we are not going to see those guys. We are only going to see the goodwill in those guys. So the goodwill, we have done the working and we have obtained our 3580. So that's the goodwill asset which we are going to endorse in the group statement of financial position. So you can say, call it working number 3. Was it number 3? Let me see. No, it's working number 2. Okay, you can call it working number 2. All right, working number 2. How much was the working number 2? How much was the value? 3580. This is the 4. Okay, and then you have to add up and you get your total non-current assets for 7,720. Now let's move to the current assets. The current assets, we just do the same. Okay, current assets, we've got inventories, this one plus that one, trade receivables, that one, cash. Then you have to add all those. Okay, so let's start with inventories. Okay, we have got 6,300 plus 2,100 plus 450. Okay, we use our calculator and we should get our 8,850. We go to trade receivables. We do the same things, just a line by line. 4.900 plus 2,000 plus 2,320. And we must get our 9,220. Then we had cash. Okay, cash assets. That's 500, 1.440 and 515. 500 plus 1.440 plus 515. add, we must get our 2455. All right. So what is the total of current assets? Obviously, that's 525. We then have to add this value and this value. Okay. We have to add. Okay. The 47,720 plus 20,525, and we should get our 68,245. Okay. Okay. That's the total assets figure. Total assets. Then we go to the equities side. The equities and liabilities. Equities attributable to the owners of the company, and the liabilities. So we have got the share capital. The share capital 50 cents odd shares. We only take the parent's shares. We only take the parent shares. If there is a share premium, we only again have to take the parent's share premium. Okay, so we are going to take the parent's shares, only the parent shares. So that's 5 million only. Okay, and then we move on to the retained earnings. You don't do the line by line because you have already done the working, which was working number 3, and which was showing total 40,680. 40,680. So if we add, we get our 45,680. Then when you do that, you then have to proceed to the non-controlling interest, your NCI. This one, we did compute it. Okay, we did calculate the NCI, and we had 12,600 as NCI. So that was working number 4, 12,600, working number 4. We then have to go back to the SFP. So far, we have done all the workings. We have included all the figures within our workings. We are home and dry. We then have to revisit now the figures within the balance sheet to see where we are going. So we've got current liabilities. Okay, so let us slot in the current liabilities figures. Here we do the line by line thing. Okay, the current liabilities, we've got 5,700 plus that one, 5,700 plus 2,280 plus 1985. Okay, we then have to add up this figure and my calculator. Let me just look for the calculator, just 1 minute. Okay, well, that's 5700 plus 2280 plus 1985. We get 9,965. Okay, so let's try to add up these figures. That plus 12,600 plus 45,680. We get 68245 as the total equities and liabilities. This should be equal to the total assets of the business, 68245. So once we've done this, then we can congratulate ourselves and say we have done the good job. So if you feel that this lecture has been helpful and is helpful, please don't hesitate to like it, subscribe, or share with your friends and peers so that they can also benefit and they might end up being at the desk at the same dining table with the Acca tutor, okay, for further business. All right, because we need the brand to be known throughout the globe. Okay, you can also do the right thing by buying us some coffee. Okay, just buy us a coffee by following that link, as you can see there, or simply scan the QR code as shown there, so that you are taken to the portal where you can make your donation if you are willing. Okay, until next time, may the good Lord continue to bless you, to make you strong, to make you healthy, to make you prosperous forever and ever. Amen.